Trent Bradshaw with Bradshaw Financial Planning and Mind Your Money. Thank you for joining us for this education session today. The title is going to be Avoiding High Taxes Throughout Retirement. We wanted to do this in person, and we had it scheduled for a live class, had great attendance already registered for it. But as normal in today's world, we're running into some COVID issues, so we did have to cancel that class, but we still want to deliver the information to you, so that's why you're receiving this video today. So again, we appreciate your time. Thank you for joining us, and let's jump right in. Let's talk about some strategies so we can try to minimize taxes throughout retirement. If you look at a couple of the bullet points of what we're going to touch on today, first, we're going to talk about household planning and just looking at it from a high level, or the things, some quick things that we can do from the local level to minimize taxes. Secondly, Social Security taxation. A lot of people don't understand how that's calculated, so let's take a look. The Secure Act, everybody's heard about it. Obviously, it came about early in 2020, so we'll take a look at some of the changes there and how that can impact also throughout retirement. 2021 tax brackets, we'll talk a little bit about that. Obviously, we're getting ready to roll into 2022. There's multiple changes that potentially could come down the line. We don't know exactly when that's going to occur, but we'll take a look. Roth IRA Roth conversions, we definitely could touch on that and the benefits of potentially taking that route and that strategy. Next, gift tax. Let's talk about gift tax and how much you can give away on an annual basis, and what are some of the strategies that we can utilize for that. Next, charitable giving, a big part of what we try to do on an annual basis, and I know we've got several clients that look at some strategies there, so we'll touch on some topics in that arena. Saving strategies, what can you do to improve your overall income throughout retirement? How can you make it more tax efficient? And then ways to keep more of what's yours. Let's take a look. All right, let's jump right in slide one here. Let's talk about household examples. Scenario here where we've got husband, wife, $2,400 in Social Security coming in on a monthly basis. Pretty much that's all the income they need. But then all of a sudden they want to purchase a new vehicle and they need $35,000 in order to do that. So they reach out to the IRA, they pull the $35,000 out all in 1 year, and down below you can kind of see some of those tax projections using 2020, 2021 as an example. The 2020 tax bill obviously would be pretty substantial, about $12,000 from the federal standpoint, roughly about $3.3K or $3,300 on the state level. 2021 though, look at what happens to the tax rate. Income from 2020, 2021, again being equal. The only difference was that $35,000 withdrawal that occurred in 2020 in this example. You can see what kind of impact it had on taxes. The 2-year total on taxes, $18,713. Well, what were some things that could have just been applied in a very simple way to reduce the taxation on that particular transaction? Well, one way to do it is just to simply, and we'll go to the next slide, take that $35,000 and blend it over 2 years. And you say, well, blend it over 2 years, what are you talking about? Well, you could have taken a distribution of half of that money in 2020, say December of 2020, and then turned right around and took the other $17,500 out in January of 2021 just to get it in 2 different tax years. But when you split that income and the impact that it potentially could have on Social Security, if you go down to the bottom, you'll see the tax bills. They equal from 1 year to the next, but the total is $16,000. So roughly about $2,000 in savings over one strategy compared to the other. So some simple things that you can apply. We just wanted to overlay just a simple example of what could occur if you really analyze and do some planning from the household level. The next slide we're going to go to is going to be taking a look at Social Security. Really, how do you look at it from a high level and calculate the taxation associated with Social Security? Well, on the slide you'll see adjusted gross income plus non-taxable interest. Non-taxable interest can be municipal bond interest, tax-free bond interest that you receive. That's included in this calculation, plus half of your Social Security benefit. So if husband and wife have a Social Security benefit of $30,000, they're going to look at 15 of that 30 in this calculation to come up with what's called a combined income. That combined income really boils down to the provisional income levels, and as you'll see on the slide, provisional income is just a measure used by the IRS to determine whether or not recipients of Social Security are required to pay taxes on their benefits. And what you'll see down below, we've got the filing status, we've got individual and joint. You look at the individual levels, anywhere between $25,000 and $34,000 of combined income, up to 50% of the Social Security could be taxable. Once you cross over $34,000 as an individual, 85% of your Social Security can potentially be taxable at that point. Now, what you got to understand is these provisional levels were put in. Reagan put the first level in. Clinton came back and put the second level in to where 85% of your Social Security could be taxable. But they never adjusted these numbers for inflation, which, if you think about it, is crazy. Everything else is adjusted for inflation. Why were the provisional income levels never adjusted? Don't have an answer for that, but that's just where we are in today's world. If you look at the joint side of the equation, levels are a little bit higher. They go from 32 to 44 for the 50% exposure of your Social Security towards taxes. And then if you earn more than $44,000 in combined income based on that above formula, then 85% of your Social Security could be taxable at that point. So there are some strategies that you can apply to try to minimize the taxes on your Social Security. But anytime you take a distribution from an IRA, maybe you're doing a Roth conversion, any of that, you've got to focus on the calculation of how much of the Social Security is being drawn in. Because indirectly, you may think you're doing a good thing by doing a conversion maybe on a traditional IRA to a Roth, but all of a sudden the income from your Social Security gets dragged into the equation, and the tax conversion rate happens to be a lot higher than you thought it would be. So again, part of that planning that you've got to take a look at. How about the Secure Act? What are we looking at on the Secure Act that brought about some changes? Well, the biggest change probably was the RMDs, required minimum distribution age. When you've got an IRA, normally it was 70 and a half when you had to withdraw monies out, based on a single life table that, of course, the IRS has put out there that we follow to calculate those numbers. But ultimately, the age was changed to 72. Now, there is legislation on the table potentially to change the age to 73 up to 75, but right now it's at age 72, which gives you another 18 months or so that you can leave your money in a tax-deferred account before you have to take out what's called that required minimum distribution. And to make it easy, what you're seeing there from the calculation itself is about 3.6 to 3.7% in that first year of whatever your end-of-year balance was on the required minimum distribution. And when I'm saying end-of-year balances, think of your IRAs. It doesn't matter if you have one, whether you have 10. You just got to lump them all in one basket. Look at the 12/31 value of the previous year, and then we take that table and that factor and we divide into that. That equates for that first year at age 72 to about 3.7% of a distribution. So in some cases it can be quite large. The other thing that would do is potentially, and we'll talk about it a little later, is gives you an opportunity to do what's called qualified charitable distributions. But again, we won't touch on that yet. We'll get to it here in a minute as far as another strategy you can apply. What about stretch IRAs? Stretch IRAs, previously to 2020, we could take a look at stretching an inherited IRA over an entire individual's life expectancy, which made the distributions rather small. Well, the IRS came in, new legislation was put in place. We have new rules now that if you inherit an IRA, you have a 10-year window to basically liquidate the account. Again, there is legislation on the table that's trying to speed that process up from 10 years into a shorter period of time. But right now it is 10 years. You don't have to touch it for the entire 10-year period of time, but on that last day of that 10th year, you got to liquidate that account and get that money out. But you have freedom to take out whatever you need during a 10-year period of time. Basically, the government wants their money. They want their tax revenue, so that's why they're forcing you to get this done. What about IRAs? If you look at IRAs, investors no longer are prohibited to contribute to a traditional, are no longer prohibited from contributing to a traditional IRA if you're 70 and a half or older now. So all you have to do is have 1099 income as a contractor or W-2 income from active employment through an employer, and you can contribute to an IRA. It doesn't matter if you're 85 years old, you still can contribute to an IRA from that standpoint. That's a big change from where we were previously. You could not participate, okay? Let's look at the 2021 tax rates, because this is important. A lot of folks, when they're taking distributions out, don't pay attention to the transition from one tax bracket to the next. You've got to take a look at that, because the 12% bracket, as you'll see, let's look at the filing jointly. You'll see it goes up to about $81,000. Well, that's pretty substantial when you add the standard deduction on top of that. In some cases, you can earn up to about $106,000 and remain into the 12% bracket. But you've got to pay attention to these brackets, because what you'll see here, going from the 12% bracket, what happens next? That's right, it goes from 12% to 22%. So it's the largest jump in the tax bracket that you'll see across the board. Now, we do work with some clients and potential clients that are in the 22% bracket or higher, and they'll never be below that. In that case, it does present some opportunities that we can do some, we mentioned it before, ROTH conversions and so forth. But paying attention to the overall tax brackets is key. Now, legislation is going to be voted on may change these tax brackets to where the top tax bracket goes from 37% up to 39.6%. There may be some adjustments throughout the other parts of the tax bracket, which we don't know what that looks like now, but obviously we'll bring you updates once we get those. Big deal though, take a look at the standard deductions below that. Single and then married filing jointly, if you're under age 65, it's $12,550 or $25,100 if you look at it from a combined status. If you're over 65, it's $14,250 and then $27,800. So think about that. If you're over 65, husband and wife, the first $27,800 that you would actually receive is considered tax-free. Not a bad deal. Pretty good provision within the tax code. Next slide you're going to see here is actually the U.S. debt clock. This brings up a big, I guess it would be a big red flag that we would take a look at when we're looking at the overall debt in the country and where we think taxes are going forward. Right now we're running about $29 trillion in debt. That debt is going to accelerate rapidly over the next 3 to 4 years, just simply from the interest cost that is wrapped into this in regards to supporting the interest on the debt itself. So by 2025, based on this particular clock, we should go from about 30 trillion in debt to about 45 to 47 trillion in debt. And once we get to that level, we're starting to get to a level where the only thing that can be supported is Medicare and also Social Security. Outside of that, any other government programs like defense and other things, there's a shortfall. So the only answer there is to increase tax revenue. And if we increase tax revenue, well then obviously we believe taxes are going up in the future. So taking measures now, taking things into your hands and taking measures to better your taxable situation, going from pre-tax to after-tax or tax-free is a strategy that we want to overlay and apply. So talking about the expectation of taxes going up, let me show you some proof that it has occurred in the past. 2021 tax bracket here, what you'll see is, we go from 10% at the bottom all the way up to about 37% as far as the top tax rate. You'll look at the 1960 to 63 tax rates, you'll see they went from the lowest rate at 26% up to the highest rate at 87%. And you look at that and you're thinking, why would somebody even get out of bed if you got to pay 87% of everything that you earn in taxes? Well, back in the 60s, that's where things were sitting at that point. But could our future tax rates go from 25% to 63% to 88%? Well, a lot of people would look at that and say it's impossible. Well, it's not. It's happened before. So we're planning on tax rates and the tax brackets going up over time. So utilizing and applying strategies to your qualified funds now, trying to make them tax-free is really what we're focused on. So if you look at the qualified ROTH distributions are tax-free, are not subject to Medicare tax, and do not add to your gross income. a taxpayer can no longer undo a Roth conversion. In the past, if you put in a conversion over into a Roth from a traditional IRA, you could come back and reverse that. That rule has now changed. There are no required minimum distributions when a taxpayer reaches age 72 when you do a Roth account. So there's another advantage of getting money from a traditional IRA over to a Roth account, Roth IRA account in the form of a conversion. You can leave a Roth to your heirs, which generates tax-free income to your heirs. Remember, they got a 10-year window that they have to access that money and liquidate. Sure would be nice to be able to take that money out with no taxation compared to being taxable. So conversions are a big deal. We think tax rates are going to go up. We attack the traditional IRAs and try to get that over into a tax-free scenario utilizing the Roth IRAs. Again, talking about Roth conversion opportunities, we wanted to show you a couple examples here, but married filing jointly couple can make $81,000 plus the $25,000, which would be $106,150 that you can make and stay within the 12% bracket. So if you think about that, that's pretty significant. You can earn up to $106,000 and be in the 12% bracket. But let's say you're earning somewhere around $60,000 or $65,000. That gives us a lot of room that we can do some traditional IRA conversions over to Roth conversions and really remain inside that 12% bracket. Now, ultimately, we're talking about, in this example, under age 65. If you're over 65, you actually can do a little bit more. But in this case, we would want to take full advantage of that. Some of our clients, when they come in, they say, well, what's the ideal income if I'm earning $60,000 or $70,000 that I want to live off of in retirement? Well, our answer is that $106,000 number, because we're going to try to push everything out of pre-tax to after-tax or either tax-free up to that $106,000 level. Now, again, like I mentioned with Social Security, we have to pay attention to that. We have to see how much Social Security is going to be drawn in. But if we look at your tax return and you already have 85% of your Social Security being taxable, we don't have to worry about that because that's the maximum that it can be taxed. And then we would move over and try to drive your income up to that 106 level through Roth conversions or distributions of whatever means we take from that end. The next level, though, if you look at the 22 bracket, because we do have some individuals that are in the 22% bracket and will not come out of it. That's where they're going to be. Best case scenario, probably going forward, assuming that tax rates are going to go up. But that level goes from $172,750 plus the $25,100 standard deduction, and it drives it up to $197,000. So if you're in the 22% bracket and you're probably never coming out of that, we're going to try to push you to do some conversions through the 22 bracket up to that 197 level, but we're also probably going to go ahead and push you through the 24 bracket, which will push it up towards roughly about $350,000 to $370,000. So there's a lot of room that we can take a look at as far as conversions are concerned. So again, we're talking about Roth conversions. Now, to qualify for a tax-free, penalty-free withdrawal of earnings, a Roth IRA must be in place for at least 5 tax years, and the distribution must take place after age 59 and a half to be able to access your growth without any types of penalties. Some of the disadvantages of conversions, I've just talked about some. If you don't have all of your Social Security being taxed, and all of a sudden we do a conversion, we might subject your Social Security to more taxation. So we got to be careful there. But conversion might not be advantageous if tax rates applied to the IRA withdrawals during retirement are lower than the tax rate paid on the conversions. Well, think about it. I just mentioned it. We think tax rates are going up. So if tax rates are going up, it's better to do them now at these advantageous tax rates than to wait to potentially higher rates later. Don't know that for sure, but that's what we're assuming. The conversion might not be advantageous if converting your Roth IRA significantly increases your tax burden. We just mentioned that. We just talked about it. We don't want to go from the 12% bracket to the 22 bracket. In some cases you might, but most cases probably not. You reduce the benefits of the Roth IRA conversion significantly if you use IRA funds to pay conversion tax. Let's talk about that. Sometimes we'll have someone that wants to convert $20,000 over to a Roth IRA. Well, if they want to use the $20,000 or some of that $20,000 to pay their federal and state taxes, they absolutely can. But if you're taking 20 and you use the taxes out of it, and let's say you only convert 15 out of that 20, you didn't get that full 20 that went into the Roth account. If you have money sitting over in a money market account, checking account, or savings account that we can use to pay the taxes on that conversion, that's the most ideal way to do that, because you're getting more into that Roth account. We're getting more opportunity for tax-free growth. All right, let's talk about gifting, gift tax. 2021 exemption amount, we can give $15,000 to as many people as we want to help lower our overall estate level that we currently have. To give you an example, the $15,000 exemption is indexed for inflation and is granted separately to each recipient. So think about that. It's increased for inflation. Well, in 2022, this $15,000 is going to $16,000. Here's an example. A couple has 3 children. The 2 parents could give a total of $90,000 to those 3 children, and the way that they do that is this. They take $15,000 each and give it to each child, but each parent can do that, so 15,000 times 6 is $90,000. That's a great way to donate or gift funds without having to file a gift tax return and moving your estate down by $90,000 in a single year. So the IRS gives us those opportunities, and it's a great strategy to utilize to be able to transition funds out to extended family. If you look at the overall federal estate tax exemptions for 19, 20, 21, and then 22, what you'll see in 19, it was 11.4 million. So what that means is, if you have an estate less than $11.4 million, then estate taxes probably aren't a concern for you. In 20, it went to 11.58. 21, it went to 11.7. 22, it was going to 12.06. Now, I do know there's legislation on the table that hasn't been voted on yet that could substantially reduce that 12 million down to 3.5, maybe to 5 million. But still, if they go to 3.5 to 5 million, it's not going to hit a large part of the population from a percentage standpoint. Right now, this 12.06, again, is projected for next year. That's not going to impact a lot of people. Think about that. Husband and wife could have 12.06 times 2, or $24 million that they pass on to extended family and not have to pay in estate tax on that. The estate tax and gift tax, if you look at it here, the top level's at 40%. So again, if you do exceed the levels that are on this page, it can be very painful from an estate tax standpoint. The annual gift tax exclusion, which we just talked about, has been $15,000 for a number of years. It's scheduled to go to $16,000 next year. So hey, we got a little bit more wiggle room in regards to those distributions. Now think about this. If you wanted to give $15,000, $16,000 to maybe children, that's great. But there's also another strategy you can use. You can take that $15,000, $16,000, maybe fund a trust, buy as much life insurance as you possibly can. If you do that, that life insurance or that death benefit could be left to your children tax-free, and you're leveraging the returns on that money. And yet, if it's in a trust, you get to designate how that child gets to utilize those funds throughout life. So you have a little bit more control on how those funds are used going forward. That's just a side advanced strategy that we can use in regards to an estate, and it's definitely something we can talk to you about if you have an interest. Charitable giving, probably one of the more exciting strategies that we've utilized with a number of clients. If you look at overall required minimum distributions, required minimum distributions are not required until age 72, and we just talked about that. And we're talking about coming out of an individual retirement account, an IRA. Qualified charitable distributions are something you can utilize from an IRA in order to give to 501c3 or charitable organizations. You can gift up to $100,000 a year from your IRA to a charitable organization, which is a fantastic strategy because it never hits your 1040. It never hits your tax return. So you're going directly from the IRA custodian straight to the charity. It obviously makes you feel good because you are able to support that particular charity. But again, you also got the tax advantages of never having to pay taxes on that IRA fund. You gave it to the charity. You can't take direct possession of it. It does have to go from custodian to the charity, but it's a great strategy to use. The reason I mentioned required minimum distributions, once you turn 72 and the government requires you to take some of that money out of your IRA account, if you don't need it, use the QCD, use the qualified charitable distribution to give to the charities that you normally give to on an annual basis. It's going to save you a tremendous amount in regards to taxes on your 1040 on your tax return, and the charity is going to be extremely happy because you're gifting funds to them on a regular basis, on an annual basis, from those RMD distributions. So look below, you'll see qualified charitable distributions. I kind of summarized all that for you. Normally SEPs and simple IRAs can't be used, but your traditional IRAs can. QCD amounts can be used to satisfy age 70 and a half or 72 RMDs, depending on where you fall there. Some folks still have to take their RMDs based on 70 and a half, but that's a whole nother project we could talk about. But again, once you turn 70 and a half, QCDs are available, or qualified charitable distributions can be made. Potentially could wipe out or reduce the amount your Social Security is being taxed. Think about that. If you live off of Social Security and that's all you need, you live a simple life, that's great. And you've got this IRA over here that you're required to take distributions out of, but you don't need it, and you're charitably inclined, think about that. You could give everything from that IRA over to the charity up to that $100,000 maximum, and it not impact your Social Security. It will not make it taxable from that standpoint. It won't come in as additional income, which could pull that Social Security into a taxable situation. So again, QCD is great, great, great strategy to use. After the IRA holder's death, when it comes to the income that flows from an IRA, think about this. The charity can be named as an IRA beneficiary, and that money will flow directly to the charity. Assets would pass directly to the charity outside of the probate process. So again, you're avoiding probate, you're naming the charity as a beneficiary, and the money would flow directly to them. And, you know, again, if you're philanthropic and you want to do that, it's an option. You can name them as a beneficiary. But you can also designate a donor advised fund. So you got to think about that too. There's DAF accounts that you can set up. You can contribute money into. You get a tax deduction for it potentially if it outweighs your standard deduction. And, you know, you have the opportunity of utilizing and gifting from that DAF account for as long as you live, or the next generation can use that DAF account to gift to charities too. Again, great strategy to potentially use. If you have an interest in how QCDs work or DAF accounts or donor advised funds work, give us a call. Brandon or myself will be glad to work with you to kind of evaluate that and see if it's a strategy that you can utilize. Also, the other thing I'll mention before we go to the next slide is, again, if you use the QCD strategy, it does meet your RMD. It does take part of your RMD requirement if you give it to the charity, so it does count. So keep that in mind. So the next slide, we're going to talk about saving strategies. Just 4 points here. Spread out your expenses. In other words, if we've got to take distributions from IRAs, we talked about it. You don't have to do it all in 1 year. If you have an expense that you need to take care of, we can separate it and split it into 2 years. Very simple process. Take advantage of low-income years. If you have a low-income year, remember, we want to get you up to the highest level, towards that 106 that we can, $106,000 a year, because, again, tax rates are pretty favorable right now. So take advantage of the low-income years, and let's start taking money out of IRAs to really take advantage of those tax rates. Use different account types as taxes increase. This is the big one. I would say, rule of thumb, our goal is to try to make sure that pre-tax compared to after-tax or tax-free is basically at a 50-50 ratio. What I mean by that is, let's say you had retirement funds of $1 million. Brandon and I try to push towards getting 50% in tax-free or after-tax compared to pre-tax. So we would want to see 50% in non-qualified accounts. We will want to see 50% over here into Roth IRA accounts, whether it's conversion or whatever, and then 50% over in pre-tax. So if we can balance the need to take money out of one or the other, definitely we could take out money from the non-taxable to help balance those taxes out. because again, we want to take advantage of each bracket that we possibly can. You're going to want to work with your CPA, your accountant. You're going to want to work with your advisor. Make sure they're talking, because this is how you maximize the strategy from the tax side of the equation. The rules that the IRS gave us, and you just got to be able to become educated in how to apply those to maximize what your benefit will be throughout retirement. The last one, use those QCDs if you are of age, meaning you're 70 and a half or older. Gifting to your church, gifting to, excellent organizations. One of them that comes to mind here locally would be Meals on Wheels. Gifting to organizations that are 501c3 organizations would definitely a great opportunity there with the QCDs. Again, that income doesn't hit your tax return. You're giving straight from the IRA over to the charity. Ways to keep what is yours, or more of the monies that you have, ways to keep more of that. Inventory all potential sources of retirement income. That includes pensions, 401ks, your 457 plans, 403bs, IRAs, Social Security payments, annuities, personal savings. You look at that and you say, well, how in the world do I do it? You got to have a written financial plan in order to do it, so you can track it year to year, know exactly where you're going to be going into the end of the year, and maximize the opportunity. Determine the tax treatment for each item and what changes your income sources may mean after your taxation. We just talked a lot about Social Security and how that can be drawn in. Make sure we're doing the calculations and helping you analyze the advantages of taking income when you need to and when you don't. Determine whether you should consider adjusting your asset allocation or asset location, to move assets into tax deferred accounts, or maximizing contributions to reduce your reportable income. Roth conversions, if we can get money over into Roths or non-qualified accounts, remember those don't come through as fully taxable or taxable at all as we move forward. So we got to analyze that for you and try to maximize 50% being on each side of the fence there. Determine which assets are subject to required minimum distributions. These rules apply to many retirement plans and generally start on April the 1st following the year you turn 72. Remember, we can use QCDs, but the other thing I'll point out here too is if you have traditional IRAs, but yeah, you got a 403b account and you've also got a 401k account, you have to take a required minimum distribution from each account because it's titled differently. You cannot lump all that together, run a calculation, and pull it from one account. You can't do that. If you got an IRA, 401k, 403b, you got to take a distribution or an RMD from each account because it's a different title. Now, ultimately, if you roll that 403b and that 401k into the IRA, then yes, you've got one structure, one title that you can look at to determine what your required minimum distribution is. And again, required minimum distributions, consider the QCD, or the Qualified Charitable Distribution. It's a great strategy to use, and you're benefiting those charities in a big way. Create a plan to minimize taxes now, especially if you fall into the highest tax bracket, and determine when you will pass assets to your heirs. So again, gifting we talked about. Life insurance we talked about. Outside of the Roth IRA, cash value life insurance is one of the other ways that you can actually grow assets tax deferred and potentially access tax free. So, those are some advanced strategies that we can look at. In some cases, we call it pension maximization. So we can look at those strategies too. But again, a lot of information today. If you got any questions, feel free to give myself or Brandon a call. We'll be glad to take a look at anything that you may have. Obviously, you see our office hours here, our phone number. Also, join us on all of these social media platforms. We try to get information out on a constant basis throughout the week, market updates, videos. We also have podcasts that are very informative, so make sure you join us for those podcasts on those platforms too. But this is Trent Bradshaw with Bradshaw Financial Planning and Mind Your Money. Thank you for taking the time to join us today. We look forward to seeing you again and hearing from you soon.